All right, and these are the journal entries to show what we did in the prior slide, where in this case jobs 12.2 and 12.3 are sold on accounts and shipped. So to record the cost of goods sold, we're going to debit the cost of goods sold for $27,000 for job 1202 and $77,000 for job 1203, and then we credit finished goods inventory for the same amounts. So if you recall, finished goods inventory, what kind of account is that? It's an asset account. Okay, and then cost of goods sold, anybody remember what kind of account that is? It's going to be a type of an expense. It shows how much you paid for something, either how much you purchased it for or how much you spent on manufacturing the item. So it's a type of expense. All right. Now the second entry is to record the sale of the items, and the sales were made on account, which means that we're going to debit accounts receivable for the sales amounts, and then we're going to credit revenue for the sales amounts. So accounts revenue, that's going to be an asset account, and a revenue is a revenue account. All right, so you always have to be aware of what types of accounts that you're using, and then it makes more sense. So accounts receivable is an asset, and you know that assets generally have a debit balance, and in this case we're debiting accounts receivable, so that makes sense. And then revenues also have, revenues are a revenue type of account, of course, so then they're going to have a credit balance. One thing to realize here is that you're going to use, when you're debiting cost of goods sold, like for job 1202, it's $27,000, but when you're recording the sale, it's $35,000. And why is that? This is telling us that our cost was $27,000, and then our sale was $35,000. So we sold it for $35,000, but it cost us $27,000 to manufacture. So of course we're going to sell for higher than what we spent, or tried to at least. So we're going to have a little bit of a profit there. Notice the same pattern for job 1203. You have the cost of goods sold of $77,000, but you sold it for $95,000. Again, you're going to try to get some profit from your sale. And then after you complete the entries, you're going to put them in the T accounts. Materials inventory has an ending balance, a debit balance of $24,000. Work in process has an ending balance, debit balance of $31,500. Finished goods is $208,500, and cost of goods sold is $104,000. And notice that all of these accounts have debit balances. Assets generally have debit balances, and expenses generally have debit balances. So all of these T accounts have their normal type of balances. So one way to one method of recording overhead is to have two different overhead accounts. Remember what we talked about earlier. When we're allocating overhead, we don't know before the beginning of the period, or we don't know until the end of the period what exactly overhead is going to be. So we have to estimate the amounts. So sometimes companies will keep the estimates in or keep the allocations in one account called the applied manufacturing overhead account, and then they'll track the actual overhead in the manufacturing overhead control account. So at the end of the period, they're going to ultimately combine the two accounts, reconcile the two, but for tracking purposes, some companies will maintain these two separate overhead accounts in order to keep things to keep from mixing the estimated overhead and the actual overhead. So because of the estimates, as we've discussed, the estimates are never going to be 100% accurate, and so you can either have under-applied overhead or over-applied overhead. It's generally not going to be right on the penny. So indirect costs are recorded in the overhead control account when they're incurred and applied to products based on the predetermined overhead rate. Now, when this rate is applied, the overhead control account is credited, and then the work in process sub-accounts are debited. Now, if it's under-applied overhead, under-applied overhead, that's the excess of actual overhead costs over the overhead cost applied. And so, if you have over-applied overhead, then you're going to have the opposite. Over-applied overhead is the excess of applied overhead over actual overhead. So, so again, to recap, under-applied overhead, you're going to have actual overhead over applied overhead, and then for over-applied, it's the exact opposite. It's applied over actual. All right, the overhead control account, as the slide says, is not a balance sheet account. Remember, we talked about that there are differences between cost accounting and GAAP. When we're talking about GAAP, we don't have an overhead control account. All overhead is going to be expensed ultimately. It could be in work in process, but those are the basic two places it can be. It'll be either in work in process or it'll be an expense. But the manufacturing overhead control account is not going to be on the balance sheet. So when we're closing out our books, even for cost accounting purposes, we're going to have to zero out that overhead control account at the end of the period. So let's take a look at these two T accounts here. We have the overhead control account with debits of $12,000, $9,500, $1370, $750, and so on. And we have the overhead control account of $51,450. And remember, those are going to be your actual overhead amounts. And then on the right side, you have applied manufacturing overhead. And what that is overhead that was allocated based on what? It was based on an estimate, right? Remember your predetermined overhead rate. So these are your actual numbers, and the manufacturing overhead, applied manufacturing overhead, is what you allocated based on your estimate. And obviously, in this situation, you should have applied ideally $51,450. You only applied $49,000, so that's why it's considered underapplied by $2,450. So we're going to have to account for this $2,450. Ultimately, overhead costs incurred need to be accounted for, and one approach is to account for the that under or over applied overhead, whatever the case may be, by adjusting cost of goods sold. All right, because overhead costs incurred were $2,450 more than overhead applied. Remember that we underapplied it in this situation. Then we're going to have to make an adjustment, and for underapplied overhead, the applied overhead account, this account, is credited for 2450, and cost of goods sold is increased by 2450. So remember, this manufacturing overhead that's based on an estimate. And now that you have the real numbers, you're going to adjust it to the real numbers, and then ultimately that adjustment is going to flow to your cost of goods sold account. Now, some firms only have one overhead account. Instead of having applied overhead and then manufacturing overhead control accounts, instead of having two, they'll just have one. And when they have one, what they do is on the left side is going to be your actual overhead, and on the right side, that's going to be your applied overhead. So again, ideally, the left side is going to balance with the right side. So in this case, it didn't. It was the right side was short by 2450, so we have to plug in an additional 2450 on the right side, and that will again ultimately flow to the cost of goods sold expense account. So whether or not a company uses two overhead accounts or one, the result is the same thing. You would still transfer any over or under overhead applied to cost of goods sold at the end of the period. Now there's another option with for dealing with under or over applied overhead. Instead of just allocating to cost of goods sold, which we did in the prior slides, in this case they are applying to the inventory accounts as well. They're applying it to work in process and finished goods. Now, why are they doing that? They look at the products that were worked on during the period, and then at the end of the month, they try to figure out where are the goods that had applied to them during the period. So in this case, they're saying that out of all the goods during the period that were worked on, 30.2% of them were in cost of goods sold, so they were already gone. 60.6% is still in finished goods inventory, and 9.2% is still being worked on. So they're going to allocate that additional 2450 under applied overhead according to these percentages. So here you see the overhead account. It had a 51,450 debit, so actual overhead of 51,450. They applied 49,000 of it based on the predetermined overhead rate. So then they had to balance it out with a credit of 2450, and that 2450 is allocated to work in process, to finished goods, and to cost of goods sold. So they allocate it based on the percentages. Like I said, they look at the products that were worked on during the period. And they determine that some of it was in work in process, some of it was in finished goods, and some of it was already sold. And so they adjust those three accounts, those asset accounts and expense accounts, according to those percentages. All right, so there are three different methods of costing that we're going to talk about now. One is going to be the normal costing. So when InShape recorded manufacturing overhead to the individual jobs, it recorded their actual direct material, because remember those were able to be traced. Direct material is able to be traced to each job. They used actual direct labor, but they didn't use actual overhead. They applied the overhead using the predetermined overhead rate. So remember, this one, is an estimate. But the estimate was based or allocated based on an actual allocation base. So in this case, in the case of InShape, they used actual direct labor dollars to allocate overhead. So they did the predetermined overhead rate, and they multiplied it by the actual base. Okay, so it's not perfect. There's a little bit of estimation going on under the predetermined overhead rate, but at least they're using the actual allocation base, so it is tied to something concrete. An alternate method is to use actual costing. And when you do actual costing, everything is the correct amount. You're using actual direct material, actual direct labor, and then the overhead is using actual overhead and the actual allocation base. So everything is a concrete number. Now the problem with this is that you're going to have to wait till the end of the period. Must wait until end. So that's something to consider here. You know, if you want quicker numbers, you're not going to use the actual method, actual costing. But if you want more accurate numbers, you don't want to have to deal with so much estimation. Then you're going to use the actual method probably. Now the third method is standard costing. Now for standard costing, you are pretty much estimating the majority of the calculation. So you have a budgeted amount of direct material, direct labor, and then for your applied overhead, you're using the predetermined overhead rate, which is an estimate, and then you're multiplying that by the budgeted allocation base. So everything here is budgeted. Again, this is called standard costing, and it's not going to be as accurate as the other two, but it's something that you can calculate beforehand because you have your budgeted amounts. However, it's just not going to be as accurate as the other two. Now we're going to talk a little bit about service organizations. Again, service organizations are something like CPA firms, law firms, something where what's provided is something that's intangible. You know, a CPA firm is going to give you paper or a disc or something, and a law firm is going to give you paper. But that's not really what you're buying, right? If you want paper, you just go to Office Depot or order it on Amazon, but you're not buying the paper in itself. You're buying the what's on the paper. You're buying the what the paper stands for. So that's going to be something that's intangible. So a service organization is going to use fewer direct materials, of course. Like I said, firms like CPA and law firms are going to use paper and other materials, but really that's not what they're selling. So they're really selling a service. Now they are going to have overhead accounts also, but those are going to have different names, and also you're not going to have a finished goods account. You're going to have an account called a cost of services billed. So they're the same concepts, but they have a few different names, and also be aware that there's going to be fewer direct materials, and understandably so. Now, when you're applying job costing methods in a service organization, it's going to work the same way. You're going to have accounts go into sub-ledger accounts or sub-accounts, and this is going to be for your clients. Direct costs are traced directly to the client, and indirect costs are going to be applied to overhead, which are in turn going to be ultimately applied to the to each client's accounts using a predetermined overhead rate. So again, it's the same thing, but slightly different names. And instead of allocating the costs to certain jobs, they're going to allocate them to clients. And finally, they want to make a distinction between a job and a project. A lot of times they're used interchangeably, but the difference per the textbook is a job is usually part of a project, or in other words, a project is comprised of many jobs. So projects are usually complex, and they can take months or years to complete, whereas a job would be smaller. You know, if a project's going to take a year, a job might take a month, 2 months or so. So that's really the only difference between the two. A project is a big compilation of jobs. A job is one part of a project. All right, question number 1. Forest Components makes aircraft parts. The question gives us a bunch of transactions in July. It says that Forest uses normal costing. So if you remember what normal costing is, that's where you use the predetermined overhead rate and you apply it to using an actual allocation base. It says that at the beginning of the year, management estimated that direct labor costs of the year would be $3 million. Estimated overhead is $2,790,000. And then it gives us balances for materials, inventory, work in process, finished goods, and cost of goods sold. But it doesn't tell us the beginning balance to all of them, so it looks like we're going to have to calculate those. But first, for Part A, it wants us to do journal entries. So let's look at those. The first journal entry is when we purchased $119,000 of materials on account. So when you're purchasing materials, remember that materials is an asset, and then accounts payable is going to be the credit since we purchased it on account. So it's going to look like that. Materials inventory is debited, and then credit accounts payable for $119K. All right. One thing to mention is that a lot of people forget, you know, whether or not they need to debit accounts payable, credit accounts payable, whether they need to debit materials inventory or credit materials inventory. I always say the best thing to do is to memorize cash. All right. So cash is an asset. And all you know is when you receive cash, that's a debit. So debit when you receive cash, and that's any cash that you receive. Okay, so that means that if you borrow money, let's say you borrow $1 million from the bank, you're going to debit cash $1 million, and then you're going to credit loans payable. Let's say you get cash as revenue, right? Someone's buying something from you, maybe a service, so you're going to debit cash because you're getting cash, and then you credit service revenue. Or let's say you're going to the store and you buy something with cash. Well, then you have to credit cash because you're paying it out, and then you debit whatever assets you bought or whatever service expense you paid, whatever it is. So memorize cash, and once you memorize cash, you can do everything else. So, for example, in the first one, it says you purchased $119,000 of materials on account. Well, again, let's say you forget which one is to debit, which one should be debited, and which one should be credited. So just instead of saying purchased $119,000 of materials on account, let's just say that it's you purchased it with cash. So when you're paying out cash, that's a credit, so that goes on the right side. And then that means that your other account that must be a debit to make it balance. That's the beauty of double entry accounting. So there you go. That's the easiest way to remember it, and that's how I always remember it. Because sometimes I forget. You know, someone asks me, does expense have a natural debit balance or a natural credit balance? And sometimes I forget. You know, so I just go back to cash. I know that when I have an expense, I'm paying out cash, so that means that I must have debited expense. All right, so just remember that. All right, now let's go to the next journal entry. It says you issued $117,000 in direct materials to the production department. So when you're issuing something to the production department, that means that you're going to take it out of materials inventory. 117.6, and you're going to you're going to move it into work in process, and they're going to call it direct materials. And that's 117.6. Oops. All right, number 3, it says issued $8,400 of supplies from the materials inventory. So we're taking something out of materials inventory of $8,400. But what do we debit here? We're going to debit manufacturing overhead control. For $8,400. So in this case, it didn't tell us that it was direct materials. It says it's just supplies, and supplies are generally not traceable to an individual job. So we're gonna debit manufacturing overhead control. All right, entry number 4, you paid for the materials using cash. So go back to my cash example. I'm crediting cash for, it says it's for, it says you just paid for the materials purchased in transaction 1. So I'm assuming you're paying for all of it, so you're crediting cash for 119, and that means you must be debiting accounts payable. So one thing you notice here, sometimes I don't do debit and then credit. Sometimes I start with a credit and then do the debit. If it's easier for me to think of it that way, then that's how I do it. Number 5, we're returning $15,400 of the materials issued to production 2 to materials inventory. So this tells me that we moved the materials out of raw materials inventory into work in process previously, but we ended up not using the amounts, not using the entire thing, so we're going to move it back to raw materials. In this case, they're calling it materials inventory. Number 6 it talks about direct labor employees. They earned $217,000, which was paid in cash. So again, I start with the easier one. When you're paying cash, that means it's a credit to cash for $217, and then since it's direct labor, we're going to debit work in process direct labor for $217. All right. Number 7, we paid $120,400 for miscellaneous items for the plant, and that the accounts payable was credited, so they already give us our credit. It's accounts payable for $120,400. Now, what do we debit here? Now we paid for miscellaneous items for the manufacturing plant, so that's an actual expense, and we're going to debit manufacturing overhead control. Next is the it says we recognize depreciation on the manufacturing plant of $245,000. So usually we would do, or what you're probably used to seeing is depreciation expense as a debit, and then accumulated depreciation as a credit. However, in this case, since we're doing cost accounting, we're going to instead of debiting depreciation expense, we're going to do manufacturing overhead control, because these costs need to be allocated to the items that we're creating so that we can track costs correctly. And then finally, for number 9, it says that we applied manufacturing overhead for the month. Now, before we calculate the number, we know that we're going to have to put the overhead into work in process, and so we're going to have we're going to use the applied manufacturing overhead account. But now we need to figure out exactly what how much we're going to allocate. So the question tells us that we are allocating based on direct labor cost. Okay, and it tells us that we're estimating that overhead is going to be $2,790,000, and that direct labor cost is going to be $3 million. Remember, both of these amounts are estimated, okay? But that's how we're going to get our predetermined overhead rate. So 2,790 divided by 3 million, that's going to give us 93%. So that's our predetermined rate, a predetermined overhead rate, 93%. So what do we do here to calculate the amount that we need to allocate? Well, we're going to take the direct labor, actual direct labor, which is 217,000. If you look at journal entry number 6, there was 217,000 in direct labor, and we're going to multiply that by our 93% overhead rate, and that gives us 201,810. So that's going to be what our journal entry is going to be. It's going to for journal entry number 9, we're going to have work in process, overhead, and applied manufacturing overhead for 201,800 for the debit and the credit. Now for Part B. Part B, it wants us to do our T accounts. So let's begin. We're going to start with materials inventory. Now the fact pattern, it does not give us our beginning materials inventory, but it gives us our ending. It says that our ending materials inventory is 88,200. And then we have several journal entries. So number 1, we had 119. If you look at journal entry number 1, we had a debit to materials inventory for 119. In number 2, we credited that account for 117,600. Number 3, we credited materials inventory for 8,400 because that was moved into the manufacturing overhead control account. Number 4, there's nothing. But number 5, we moved some materials back to materials inventory, and that was 15,400. Okay, so we need to figure out what our beginning balance was. So let's see how we can do that. So we need to figure out what our beginning balance is for material inventory. So let's first of all, let's add up our debits and our credits. If you add up your credits, you get 126,000. And if you add up your debits, you get 134,400. Okay, and from here we're gonna do a simple algebra equation. So we know that x plus 134,400 minus our credits of 126, and that's going to give us an ending balance of 88,200. All right. So what do? We add $126,000 to both sides, and then we subtract 134,400 from both sides, and then finally we get x equals 79,800. All right, so remember we removed these two from this equation. From this side of the equation, essentially we added it to this side, and we get x equals 79,800. So our beginning inventory is 79,800. All right, so you're going to have to do this for 2 other accounts. For work in process, again, you know that it shows that your ending balance is 73,500. So you know that whatever your beginning is plus your your beginning balance plus any debits minus any credits is going to give you your ending balance. So I'm going to let you calculate a work in process, inventory, beginning balance on your own. So you'll get some practice on that. You're going to have to do a few other accounts as well, but I'll give you a couple of hints here in case you're having problems. You have manufacturing overhead control and applied manufacturing overhead. Keep in mind, remember what we learned in the PowerPoint, that your manufacturing accounts, your manufacturing overhead accounts, manufacturing overhead and applied overhead. Remember, the slide said these are not balance sheet accounts. So what does that mean? That means that at the end of every period, these accounts are closed out, and if they're closed out, that means that their beginning balance must be 0. So for your manufacturing overhead and a control account and the applied manufacturing overhead, those are going to have a 0 beginning balance. I didn't give us any information on accounts payable or cash having a beginning balance, so we're going to assume that those have a beginning balance as well. For depreciation, yeah, it didn't give us any information about accumulated depreciation. So I guess this is the I would assume this is the the first year of business, but I'm not sure about that. But anyway, those it didn't give us anything for a beginning accumulated depreciation balance, so that's going to be 0. But then it wants to know what the beginning balance for cost of goods sold is. And that's another trick that they're trying to throw at you. Remember, cost of goods sold, that is not an inventory account. Cost of goods sold is an expense. And just like any other expense, it's zeroed out at the end of the period. So there's not going to be a beginning balance. You're not going to find cost of goods sold on a balance sheet. So beginning balance is going to be 0. So you don't have to try to find that number. And then you also have finished goods inventory, but the problem gives you both the beginning and ending finished goods amount, so you should be able to compute the rest. All right, so that's going to be question number 1. All right, question number 2. Southern Rim Parts is estimating its manufacturing overhead to be $495,000 and estimating that its direct labor cost is going to be $900,000. And they're allocating overhead based on the basis of direct labor cost. So the first thing we need to do is figure out what our predetermined overhead rate is. So if they estimate that our overhead is going to be $495,000 and they're basing it on direct labor cost, that's going to be $495,000 overhead divided by $900,000 direct labor cost. That gives us a 55% rate. So whatever we calculate for, whatever actual direct labor cost we have, we're going to multiply that by 55%. All right, so for A, it says that job 301, its actual direct labor cost was $20,000. So we're going to multiply that by 55%, and we get $11,000. Okay, and then for job 302, it's $30,000, and for job 303 is $22,000. All right, so you guys do the math on this, so multiply it by 55%, and fill in the rest of part A on your own. Okay. Now for part B, it says what is the over or under applied manufacturing overhead for year 1? All right. So part A and part B, they're not. You're not going to use the information you calculated in part A to get to part B. I mean, those individual jobs aren't going to make a difference. The question tells us, as I said, that we estimated manufacturing overhead to be $495,000, and we estimated direct labor cost to be $900,000. Now, the fact pattern tells us that our actual direct labor cost for the year is $850,000. So that means that if we're applying overhead based on that, that means $850,000 times 55%. We actually applied $467,500 in overhead. Now, our actual overhead is $479,000. So that means that we underapplied by $11,500. All right, so the answer to B is underapplied by $11,500. Number 3, we're also doing a predetermined factory overhead rate, but instead of basing it on direct labor dollars, we're basing it off of machine hours. So the question tells us that we budgeted overhead, we estimated overhead to be $714,000. And we estimated machine hours to be 68,000 machine hours. So that would be a rate of $10.50 per machine hour. All right, so that's our predetermined overhead rate. Now the question tells us that we actually actual machine hours is 69.5. So we ran our machines a little bit longer than we thought we were going to run. So how much overhead did we apply? We applied 69,500 machine hours times 1050. So we actually applied 729,750 overhead. Okay, and how much overhead did we actually incur? Actual is, let's see, it says it's 773,500. All right, so overhead actual is 773,500. We applied 729,750. So we didn't apply enough. Our estimate was off, so that means that we underapplied by 43,750. So your answer to number 3 is underapplied by 43,750. All right, question number 4. Marine Components produces parts for airplanes and ships. The customers either pay a fixed price or they'll pay, depending on how much it costs to build something, plus a fixed fee. It says that in year 2 they only expect 2 clients, client 1 and client 2. Client 1 is under fixed price, client 2 is under cost plus. They're using direct labor cost as the allocation base. Year 3, they expect 2 clients again, but one of the clients is different. Instead of clients 1 and 2, it's clients 1 and 3. Client 1 is still on fixed price contracts, and client 3 is on cost plus contracts, so same as client 2 from the prior year. Manufacturing overhead for year 3 is estimated to be 12 million, and then it gives data for machine hours in the thousands and direct labor cost in the thousands. And so part A wants us to compute the predetermined rate, assuming that you're using machine hours to apply overhead. And it says round your answer to 2 decimal places. All right. So the fact pattern gave us a lot of information that we don't need for part A. I don't know if we're going to need it for part B, but definitely not for part A. We're applying overhead to based on machine hours. It says that estimated overhead is 12 million. And I'm going to go ahead and write it out. I don't like these problems where they give you numbers in the thousands and then you have to add zeros and stuff like that. It tends to be kind of confusing, so sometimes I'll just write out the number. But overhead is expected to be 12 million, and machine hours looks like it's client 1 is going to have 3 million machine hours, and client 3 is going to have 7 million. So 3 million plus 7 million, that's 10 million. So you're going to do 12 million over 10 million machine hours. And that gives you $1.20 per machine hour. So that was 4A. All right, $1.20 per machine hour. Now it says for Part B, compute the predetermined rate, assuming that Marine Components uses direct labor cost to apply overhead. So now instead of machine hour, we're going to allocate this 12 million based on direct labor cost, and the problem tells us that direct labor cost for client 1 is 3 million, and it's going to be 3 million for client number 3. So it's just going to be 12 million over 6 million. So that's going to be 200%. So that's going to be your rate for Part B, 200% of direct labor cost. So again, a lot of this information that they gave us in the problem about cost plus or fixed price, all that stuff didn't make any difference in the problem at all. So sometimes you get problems like that. You just have to read through it and just be aware that this is a trick that the publishers like to do. They'll give you extra information that you don't necessarily need. All right, and then finally, question number 5. Now we're looking at a service firm, a dispute mediation firm. It has 2 clients, Massive Airframes and Gigantic Dry Docks. Massive Airframes, the company worked 440 hours for, and then Gigantic Dry Docks, they worked 660 hours. Allocation Busters, which is your company, bills them at a rate of $500 an hour, but it only costs them $200 an hour, so it looks like there's a $300 gross profit there. Overhead cost in March is $42,000. Overhead was applied at a rate of $40 per hour. And then you also had $200,000 in marketing and admin costs. All transactions are on account, so there was no cash, and all services were billed. So it wants us to record 4 different transactions. It wants us to do T accounts, but I'll let you guys do the T accounts, and I'll do the journal entries. So for A, it said record the labor cost. So first we need to calculate what the labor cost is. The question, the fact pattern tells us that our cost is $200 per hour, and we had 440 hours for massive airframes, and 660 hours for Gigantic Dry Docks. So you add those that up, and you get 1,100 hours. So you do 1,100 hours times $200 an hour for your cost. So you get $220,000, and so that's going to be your cost. That's your labor cost. So that means that these are wages that you're going to pay. Usually, as we talked about before, you would, if you're doing GAAP, you would debit wage expense and credit wages payable. But in this case, since we're a manufacturing firm, we're going to debit work in process by $220,000 and credit wages payable for $220,000. So that's what your journal entry is going to look like for the first transaction. Then just stick that into the appropriate T accounts. Now for B, it says to record applied service overhead. So remember, we're applying based on the estimate, and we're applying based on the overhead rate of $40 per labor hour. So the question tells us that we are applying overhead per labor hour. So so that means that we have our 1,100 labor hours that we calculated in the prior, in Part A, 1,100 labor hours, and we are applying $40 per labor hour. So let's just do that math, and that gives us $44,000 overhead applied. Okay, so when you do the journal entry there, you're going to have let's see, you're gonna debit work in process for $44,000, and then you're going to credit applied service overhead for $44,000. All right, so that's your journal entry for B. Now for C, it says record the cost of the services billed. So here, what we have to do is we look at we can look at let me see. So if you recall, when we're doing a manufacturer, we're going to have raw materials, work in process, and finished goods. But when we're doing services, we're going to have work in process and then cost of services billed. So when the question says that we have to record the cost of services billed, and it also tells us that all services were billed, then what we're doing is we're allocating all of the work in process inventory into the cost of services billed account. So work in process, for A, we debited it for $220,000, and for B, we debited it for $44,000. So we add those up, and we get $264,000. So when we're doing our journal entry, we're going to credit work in process for $264,000, and we're going to debit our cost of services billed for $264,000 as well. So that's what your journal entry is going to look like if you were going to journalize C. And then D, we have to record the actual overhead. So for so applied overhead was what we did in B when we did the $40 per labor hour times the 1,100 hours. So we applied $44,000, but the fact pattern tells us that actual overhead was $42,000. So we over applied by $2,000. So when we over apply, that means that our cost of services we thought was $264,000, but it was actually $262,000. So we applied a little bit too much. So we had to do a closing entry where we're going to credit cost of services by the 2000 excess, and then we're going to close our service overhead control account. Now that account had a credit, a debit balance of 42,000, and we're going to have to debit our applied service overhead by 44,000. So that's what the journal entry would look like for Part D. All right, so take all of these journal entries and put them into T accounts like we practiced in the prior questions. Use the numbers that are here in the journal entries. All right, now for Part B, they want us to prepare an income statement for the company of March. Income statements are always going to be revenues minus expenses. So we're going to start with sales revenue. Sales revenue, it tells us that we're charging $500 an hour, quite a bit of money there, and we have our 1,100 hours that we calculated in the prior Part A. So 500 times 1,100 hours, that's going to give us $550,000 for sales revenue. Then our cost of services, that was 264, but remember that was a little bit off because we applied that 264 includes the applied overhead, and remember we applied overhead of $2,000 too much, so we're going to have to subtract over applied overhead of 2,000. So these two are going to net to 262. So our gross margin is 550 minus 262, which gives us 288. And then we also have to subtract our marketing and administration for 200,000, which was given to us in the fact pattern. So our operating profit is 88,000. All right, so that's Part B. All right, so that was question 5 of the Chapter 7 homework. Again, if you don't do the homework before you watch the video, I strongly urge all of you to do so. Otherwise, the lecture and the homework problems don't make much sense, and they don't give you you can't get much out of them. But if you have any questions, send me an email. Otherwise, see you for Chapter 8.